Meanwhile, the numbers as far as Reliance, which were expected, are now out. 15,790 crore rupees profit after tax coming in. My colleague Ajay Sharma is joining us for further perspective on Reliance numbers. Ajay, over to you.
Well, that's correct. Thanks very much for that, Vikram. Reliance Industries' third quarter numbers is flashing on your screen right now. The Geo numbers came in a while back. We'll flash those numbers also jointly. So almost 15,800 crore is the kind of profitability they've clocked this quarter. We were expecting 15,990, almost 16,000 crore. On that base, it will go down as an inline set of numbers. It will be interesting to see what are the components of that profitability this quarter. We were expecting a healthy growth in retail end of the business. Even O2C was supposed to rebound. Revenue is almost 2.25 lakh crore versus a poll of 2.18. So in line with estimates is what the top line also is. Naveen Kulkarni is joining us now. We'll start by understanding the Geo end of the business. Uh, Naveen, Geo numbers also came in just a while back. What are your thoughts on, at least for starters, let's understand how did the quarter go for Geo?
I think you have to look at the metrics per se for Geo numbers to make up a better understanding. That we were expecting an ARPU improvement of almost around 2% in this quarter to 180 and subscriber addition of around 5 million subscribers. So I will have to look in that context. That operating metrics are very, very critical to analyze Geo. Otherwise, on profit basis, I would say that the numbers look largely in line, but the key operating metrics are going to be the more important factor to watch out for.
600 crore is the kind of profits Jio has actually clocked this quarter. What was your own estimate of ARPU and the subscriber addition? Has that improved this quarter in your view? What was your own estimate?
The ARPU and think million subscribers. I think key numbers are to Geo numbers in manner.
What about the other end of the business, retail, uh, O2C? Is that also witnessing improvement? Because we did see some pressure on at least the O2C a few quarters back. Has that normalized in your view?
Sorry,
See,
yes,
oil
so I
to
just
chemicals end of the business.
lost to rebound in this quarter. The realizations were slightly better. The spreads were slightly better in this quarter compared to last quarter. Also, the tax implications were also slightly lower. So I think this quarter for O2C business was expected to be a rebound. As far as the retail business, considering Q2 was a strong quarter, Q3 was expected to be, I would say that growing slightly on Q2, but not very large growth on Q2 numbers. Considering whole quarter we stand out, November was slightly weaker month. December probably would have been some rebound. So you have to look into that context. Not significant expectations from the retail business per se, but the O2C business was expected to do very well in this quarter.
Well, that's correct. And it has contributed. Both polymers and polyester demand has improved in our understanding, and that has actually contributed. Also, the EBITDA, there's a beat of almost 2,000 crore as far as the uh, almost a okay in line actually. That's a bit. Please pull up the EBITDA end of the business. That is very important. The consolidated EBITDA would also come up on your screen. There seem to be yes 35,000 crore. We were expecting 33 half. So there's some amount of beat there. Unconsolidated EBITDA. Where do you think the higher end of the profitability, especially on margin front, is coming from, Naveen? Because Geo2 is almost a 50% plus kind of a margin business, retail high margin. Where do you think is the driver of the profitability in all the businesses put together right now?
Yes, so clearly the profitability from let's say a medium term perspective has to be from the O2C business. Right? So if you look at let's say retail business, the margins are
Okay,
still low.
right. Mayuresh Joshi is also joining us to analyze the numbers. Mayuresh, what are your initial thoughts? There seem to be a beat on EBITDA. Uh, Top line, bottom line seem to be in line. What to your mind would have gone in this kind of performance?
Evening, Ajay. So I think for Reliance, top line is inconsequential. It's specifically the EBITDA front that is far more important. And yes, I think the EBITDA has been a beat as far as the Reliance is concerned. As Naveen was also pointing out, and as you were mentioning as well, specifically in terms of the petchem part of the business. I think that business would have done well because the PE spreads had actually recovered quarter on quarter. Though PVC PP margins would have been lower, but I think the PE spreads would have been far lower. Now, the other element in terms of the overall business perspective as far as the energy vertical is concerned, Singapore GRMs had largely remained subdued, but are slowly bottoming out and are expected to improve going forward. So the energy vertical is showing definite signs of improvement. Retail, in my opinion, has remained steady. I think, and as far as the digital services part of the business is concerned, even that part of the business has remained steady. So I think the EBITDA performance seems to be good prima facie for Reliance, better than what the street was expecting.
I have a follow-up question on the O2C end of the business. If we distributed domestic demand, which seemed to be very buoyant on the polyester polymer side, and overseas demand, which is slightly on the softer side, especially China and parts of Europe. What are your observation? What kind of a sequential trend will O2C take from here on?
So if you largely track the spreads, Ajay, specifically on the petchem profitability, though they would have been mixed this time around, with China reopening at this point of time, the expectations in terms of petchem spread across P, PVC and PP should be relatively better on a sequential basis. The second element is also the higher gas water prices. So if you probably look at the oil and gas part of the business as well, on the energy vertical, particularly as you are asking me, that should probably also aid along with higher volumes. And the third element, as I said, Singapore GRMs largely would have bottomed out. They should largely show signs of stability and improvement going forward. And because the Reliance has got a larger access to different feedstock, the outperformance there would largely be coming through in the next few quarters. So I think all these three parts would ensure the energy vertical probably sustains reasonable growth going forward, along with the other legs, which obviously are retail, including Geo and the retail.
In fact, you spoke about EBITDA. EBITDA for retail is also higher. Geo, of course, we spoke about, and overall operating margin is also higher by about 1%. I want to talk to you about Mayuresh. Naveen, I'll come to you in a minute. I want to talk to you about the overall debt levels that seem to have gone up slightly this quarter, and they had guided for it as well. Okay, we've got Sushil Choksi also joining us. In fact, why don't we invite Sushil also in the discussion and take that question. Sushil, that concern of debt, it seemed to have edged higher, but of course, they've told the market that for 5G and other capex, debt will go higher. Is that built in, or is that still a bit of an issue? How will market read it? Oh, we lost Sushil. So the question will come right at Mayuresh. It was meant for him coming back to you. Mayuresh, please answer that for us.
I think, as you rightly pointed out, a large part of that had been covered in last quarter's numbers as well. The capex plans, Ajay, as they've put out, specifically in terms of the new energy vertical, green hydrogen, is going to get spread out over the next few quarters and next few years as well. But overall, I think the leverage situation is quite manageable in my opinion. As new capacities, specifically related to the new capacities and new vertical that they're putting through, starts coming through, it will be front-loaded on the balance sheet at this point of time. But one has to look beyond the first few years for the initial leg and the medium leg of the capex. Because ultimately, I think as capacities start building in, the back-ended revenues will be quite substantial. So I think the street has factored that in. Not too worried in terms of the leverage position. I think it is still manageable at the overall consolidated.
That's Sushil. All right. So Naveen, have you seen that in the last few quarters, their contribution from E&P seem to be going up? In fact, as I understand, then one of their fields, MJ, will also be participating. So now, which was almost absent, meaningful contribution from E&P was absent, but now with every passing quarter, that is going up. How much value are you assigning to E&P right now?
Yeah, so in the overall scheme of things, at this point in time, E&P will still be a smaller portion. And see, if we look at the overall valuation for Reliance at 2,500 crores, sorry, 2,500 rupees, let's say the stock price. I would say that 35 to 40% of the value comes from the retail business, and then Geo is another substantial portion which contributes to another 25% plus, right? So from that perspective, if I were to look at the overall the oil and gas business, the E&P business will still be a very small part, right? Not very small, but it will be a smaller portion. So for that business to make substantial contribution and to get contribute substantially in the overall valuation, I think it could take some more time, in my opinion, because these are businesses which don't get very high multiples. So probably the valuation in the overall valuation game, I would say that E&P will take some more contribute
Sure.
some more.
So that has O2C has actually performed very well, and they are saying that sustained O2C segment performance has been led by strength in middle distillate cracks and advantaged feedstock sourcing. Well, that is one of the strengths of this company. And Sushil is also joining us on video now. Sushil, how do you read the numbers? You may have gone through bulk of the numbers versus what the street was penciling in, or this quarter reading stock reaction from the results actually may be inconsequential.
Thank you for having me on the call. Apparently looks better than what the street was estimating, led by oil to chemical division and oil and gas both. The margin seems much better than what was estimated by the street. And I'm happy with the profitability, which is specifically coming from the main petrochemical business of Reliance.
Finance costs, Sushil, which has seemed to have edged higher, do you think this is temporary and will peak out in 2-3 quarters? Because that seemed to be worrying the street a bit.
I didn't get your question, Ajay.
The finance costs, because of higher, one, their capex is high, so debt is also coming on the balance sheet. Plus, we understand that even on forex side, there has been some extra, costs which they have incurred. So overall, total finance costs have edged higher.
As rupee dollar parity has moved from the previous quarter to the current regime around 80 to 83, that would have been capitalized partially for the expansion, but there would be a cost and mechanism. But the natural hedge on a partial export is also possible. But my personal estimate is that by June, the major capex on the current phase would be over, and we need to watch out for the next expansion led by the new energy business of hydrogen and solar. So what kind of capex will happen? But currently, I feel that the cash profit generated by the company would be in the region of almost 1,40,000 crores, and that should taper off the debt from the balance sheet, which was 90,000 crores in the last quarter. I don't have the current number, but I feel Reliance has a potential within a year again to be debt free. But Reliance always manages to borrow low and deploy that money, so they always show a cash and net debt separately.
So what kind of valuations, Mayuresh, what kind of valuations are you giving to the combined entity right now with all business put together? Because there is enough talk on the street that gradually, in fact, in the next 12 months or so, businesses may start coming apart and be separately listed. Right now, how would you value them? How much multiple are you giving?
So if you look at the respective segments, Ajay, on the refining and the petchem part of the business, on an optimistic basis, looking at 24 or even rolling over to 25 numbers and EV/EBITDA of 8 times will probably suffice for the standalone business. If you're probably looking at Geo and retail combined together, I think retail will obviously subscribe higher multiples. Maybe this quarter or two, because of discretionary demand going down a tad bit, might affect the numbers on the operating front. But overall, in the next 2 to 3 years, a higher multiple of 36, 37 times for retail and around 19 odd times on an EV/EBITDA basis for digital services. So I think if you break that up on an SOTP basis, there is still substantial value on the upside for that.
Right. Naveen, what about you? What kind of multiple you have, and do you see scope of multiple expansion as more visibility sets in and the street sees more visibility on their new hydrogen and new energy business, say in next 12 to 15 months?
Yeah, so from a perspective of what kind of multiple expansion can happen, I don't believe that there can be significantly higher expansion of multiples from the current levels, because if you see the implied multiples for the retail business is already quite high. Geo, we see that the growth from here, of course, from subscriber addition is going to be challenging unless and until we have operator which goes belly up, or there is a bankruptcy or something of that kind. If that happens, so overall, I would say that from here on. Multiple expansion is going to be a challenge. Even if I were to look at the other new businesses, which is hydrogen and others, what kind of ROE they will generate, whether it will suffice to give a higher multiplier than what the business is enjoying, which is something which remains to be seen. But core operating profits, if they improve from the oil and gas business and the O2C business, I think that can take the stock up higher. So I would believe the stock is more likely to move in line with earnings growth than see a major multiple expansion from these levels. Of course, listing of entities can have a effect, but overall, from a perspective, I feel multiple expansion limited, but earnings growth can be the trajectory in which the stock should move.
Let you have the closing comment, and we'll start with that point which you said that the operating performance this quarter seemed to be slightly better than what the street was estimating. The other two triggers, one is demerging and listing of some part of the business, and the other growth and the speed of execution on the hydrogen business. What kind of developments do you expect in the next 12 months on these two fronts? Because these are the significant drivers which street is expecting for the stock price.
Is that question to me, Ajay?
That's correct, Sushil.
Going to business performance, I think the numbers are very stable for the current stock price from a perception if you take a 12-month outlook. My India consumption is on a high note, irrespective of the current interest regime, which is on a higher trajectory. The globe may have ups and downs, but the diesel demand, specifically for some Western countries, and oil to gas having additional production in India will support some of the margins. And local petchem and polyester would have a substantial higher output in the year to come by, would take oil to chemical division for a higher multiple and as well as a price breakup. So, the street is typically pricing in 1200 rupees per share for retail. With a growth trajectory, you may give 10-15% year on year higher, depending on number of store rollouts and initiatives they take. The similar is for Jio, but nobody is estimating which the rival competitor Bharti is spelling out that the ARPU needs to go to 300. Today we had 178, 179 for Reliance. Let's assume that in a year and a half or two, they are visible around 225, 250 range. What will happen to the Jio's valuation? We don't know what kind of impact 5G has on a consumer base from a usage point and how the valuation will change where Jio is concerned on a standalone basis for performance. Coming to a new initiative of hydrogen and solar combined, I think it's a stage where Reliance has invested in a lot of technologies by making some acquisitions globally and also companies which are doing implementation. So hydrogen is part of the oil and chemical business today from a manufacturing perspective, but green hydrogen needs all these new initiatives. So currently UBS has put a $8 billion valuation, which amounts to approximately 100 rupees a share. But the reality of that division should fructify from a shareholder perspective sometime in 24-25, not earlier than that. So the size and scale what Reliance wants to achieve there, even on solar, whether they can get to 10 gigawatt by that time, hydrogen is linked to that and what kind of production they are able to do it. At the same time, the cash flow from the other divisions would support. So if you take a compounding from a next 12 to 18 month perspective, the real picture of Reliance, three different verticals should be in place from a market perspective, and the return for the entire capex which they have announced for all the divisions also should have a little better vision from a shareholder perspective how it's getting rolled out. So I'm quite excited in a choppy market, specifically when India is not attracting a lot of foreign investors. The retail investors have a good potential to make money on the stock, buy on dips, and I think 15-20% return in calendar of 23 is definitely possible. And if there is some upside created by some kind of a listing norms which are being spelled out for the other divisions, that would be the upside which can be factored in. But I'm quite happy with the result compared to the street estimate, and I would be very optimistic on oil to chemical division to support Jio and retail along with it.
Yes, that's correct. In fact, that could be the gist of this quarter, that O2C have actually rebound very sharply and is powering the overall quarterly performance. Naveen, Mayuresh, and Sushil, all three of you, thank you very much. In fact, Sushil said 15-20% in this calendar. That's a big FNO stock and may also have a driver of a corporate action. So keep that in mind. But I'll go to my analyst, Saumit, to wrap up the results. He's been working the phones and have spoken to a lot of analysts on the street ahead of the results to tell us how the results actually fared in his eyes and also what the street was expecting this quarter. Saumit?
Well, if you see compared to the street estimates, the revenue and net profit is pretty much in line, but the big beat for Reliance Industries has come in on the EBITDA front. Now, street was expecting the EBITDA number to be close to 33,700 crore rupees, but the company has reported an EBITDA of close to 35,247 crore rupees. So this big beat has naturally come in from the O2C segment, because there the number has grown around 16% on a sequential basis, and the O2C segment's EBITDA is close to 13,900 crore rupees. Now, this is on the back of the fact that in the third quarter of FY23, the export tax was removed from SEZ, that is a special economic zone where Reliance Industries has one of its refinery unit, and also on a relative basis, if you see, the impact of windfall tax was lower in the third quarter of FY23. Now, moving on to the other segment, that is the retail segment, the performance is pretty much in line with what the street was expecting. Retail EBITDA is higher by around 7%, and that is what the street was expecting. And the biggest growth or the sequential growth has come in from the oil and gas exploration segment, and that is purely on the back of higher production and higher gas prices in the third quarter. We have seen a sequential growth of close to 22% when it comes to the gas exploration business. And lastly, when it comes to Geo numbers, we have seen a marginal miss coming in on the EBITDA front, and that is because the ARPU number for Reliance Geo has also come in slightly below than what the street was expecting. Street was expecting the ARPU number to be close to 179.6, but the company has reported an ARPU of 178 rupees per user per month. Now, to sum it up, the result, the O2C segment was a beat. Retail, oil and gas exploration was in line with the street estimates. Geo was a marginal miss, but the overall numbers on the EBITDA front looks a good 5% beat compared to what the street was expecting.
All right, Sumit, thanks very much for that. With that, it's a wrap on this special coverage of Reliance's quarterly numbers. The gist is that numbers are slightly on the higher side. Our poll actually shows in line. It will be interesting to see the stock has gone weak into the numbers, how the street treats these numbers. Thanks very much for watching. Goodbye.